Okay, okay. You are welcome to this new lesson. Uh, in this, we are going to discuss about the depreciation. I am going to teach you what is the depreciation, how to do the depreciation, and what are the methods of depreciation. Okay, okay, okay. You are welcome to this new lesson of depreciation. Today, I am going to teach you what is the depreciation and what is the meaning of depreciation and how to what are the methods of depreciation and how to do the depreciation through working out the small questions. Okay, so first of all we have to see what is depreciation. Depreciation is the charging of the cost of non-current assets over its useful life, right? Charging of the cost of non-current assets over its useful life, I mean its lifespan. So useful life over its useful life, non-current assets, non-current assets, charging on the cost, charging on the cost, right? These are the keywords you have to remember. These are the keywords you have to remember. Depreciation is the charging of the cost of non-current assets over its useful life. What are the non-current assets? Land, building, hmm, machineries, equipments, motor vehicles, furniture and fittings, hmm, etc. and etc. But those are the non-current assets over its useful life, over its useful life in the sense its lifespan. Okay, its lifespan. For an example, for the human beings, okay, the human beings lifespan is 60 or 70 years. Lifespan is 60 or 70 years. Like that, we will live only up to 60 or 70 years lifespan, calculated based on average matter. Okay, so useful life, non-current assets over its useful life, cost of non-current assets. So like that, every furnitures or equipments or motor vehicles will have its useful lifespan. If you purchase today a motor vehicle, will not have the same value after 5 years or next year. Even after 2 days it won't have the same value. Once you purchased and used it for 1 or 2 days, even you cannot sell it at the purchases you made, the cost you have paid. It will have a low price because we have used it. Its useful lifespan will come down by the useful the by the time we have used. Okay, understand? So like that, like that, we have all the assets will have a lifespan, and if we purchase it for 10,000 today for the year 1, in year 2, 2, 3, 4, and 5 it will have a lesser amount, right? We cannot sell the on the purchase price at the time of selling after 5 years. It will have a very lower value. So that is what we are going to see. At the purchase price we cannot show in the balance sheet, right? Because economic value of the resource, the balance sheet show the economic value of the resource we have. So these assets are resource of the entity. So if we show the purchase price at the time after the 2 years or 3 years time, it will show a very wrong picture because you are overstating the value of your assets, which will not have the same value you have mentioned in the balance sheet. Okay, because you have utilized that particular asset for last 3 years, then the value of the asset would have come down, so you have to value it. Okay, after 5 years what is the value? If you say after 5 years it will have a 1,000 rupees value, then you have to, the difference is 9,000. So after in the year of, in the fifth year you cannot show the 10,000, you have to show the scrap value of 1,000. Okay, so this particular amount 9,000 has to be charged to the profit and loss account on a reasonable method. That method only we are going to study today, in which method we can charge this amount to the P&L, right? Okay, understood? So methods of calculation of depreciation. Second one is methods of calculation of depreciation. Methods of calculating the calculation of depreciation. Okay, one is straight line method, right? This is through straight line method we can depreciate. Another method is reducing balance method, right? Method reducing balance method. You may wonder what is the reducing balance method, what is the straight line method. Okay, we are going to see. The straight line method is, under this method we charge an equal amount of depreciation each year. Under this method we charge an equal amount of depreciation each year. The example I shown, under this method we charge equal amount of depreciation each year. Okay, you say 1 2 3 4 5 5 years, lifespan is 5 years, scrap value is 1000, so 9000 has to be depreciated under 5 years. So we had to divide it by 9000 has to be divided by 5 years, and that is the amount you have to charge each year. Straight line method. The amount chargeable to the profit and loss account or to the asset is a will have an equal amount. There won't be a difference. It won't vary year to year, right? It will have a same amount of depreciation. In this case, for the easiness, I am taking the amount, scrap value is purchase amount is 11,000, right? 11,000. Then it will be easy for us for the calculation. 10,000 is the amount. So 2,000 we had to depreciate it. 2, 2, 2, 2, and 2. So 10,000. And at the end of the year we will have a thousand as a scrap value we can sell it. So each year the accounts going to show a reasonable value of the assets, non-current assets. So that is the straight line method, I think. So here there's an equation. This is original cost, okay, original cost minus residual value. Original cost minus residual value. This is the original cost 11,000, residual value is 1,000. Estimated useful life. Estimated useful life is 5 years. Okay. So original cost is 11, residual value is 1, then 11 minus 1, 10,000. Estimated life is 5, then 10,000 divided by 5, 2,000. We are reducing it. Okay, understood? We are charging. Charging in the sense we are deducting from the non-current assets. So the example, we will see the examples, right? Example, Reagan has a year end of 31st December each year. Reagan has a year end of 31st of December every year. His accounting period ends starting from 1st of January. This is what they are trying to say you. This is what they are trying to tell you, that the financial year the Reagan follows is 1st of January to 31st of December. That's what they mention here. On 1st of April 2022, purchase a car for 120,000. He's purchasing a car for 120,000. So we have to open up what he called cash account. Cash and car. Car. Car is a non-current assets. In the cash, we are paying a cash of 120,000 we are purchasing, then cash account is debited 120,000, and car account is debited, cash account is credited. Okay, here you will say cash, here you will say car. Okay, because we are purchasing a car is coming under the assets, non-current assets. So when there's an increase in the non-current assets, there has to be debited. So we are debiting the car account 120,000, and cash also an asset, non-current asset. Cash is decreasing. So when the non-current assets are decreasing, when the non-assets are decreasing, it has to be credited. So we have done that. So the double entry part is completed for this. Then the car is expected to last for 5 years. Car is expected to last for 5 years. Then what they are trying to say is lifespan, useful life, useful life, right? They are saying 5 years. It will expected to last for 5 years. 5 years. Okay, 5 years. And to have a scrap value at the end of the fifth year is 20. Scrap value at the end of the year is 20,000. So okay, you have jot down the facts of this question. So cost cost 120,000. Then it is summarized it and keep it for your reference. This thing. You have summarized the question. One is facts of the question. One is cost is 120,000. You have identified the cost, and you have identified the useful life 5 years. Scrap value also we have identified 20 years. So rest of the thing is easy. So rest of the things are easy because it is a matter of double entry. Here we have made the double entry for the cost of purchases, right? Okay, now we have to pass entries for the questions only. The question is calculate the depreciation for each year for 3 years. We have to calculate the depreciation for the 3 years time. Okay, so I'm going to open a depreciation account. Okay, debit and credit. Here the entries for the double entry for the depreciation I didn't give you. Now only I have recognized. Double entry for the depreciation. Anyway, no problem. We can give it you the link. Now, right, when we are making a depreciation, we have to take asset value should be the same. Asset value in asset register, we are not going to touch the asset account, right? Here what we are going to do is depreciation and provision, two accounts we are going to create. That is, one is depreciation and other thing is provision for depreciation. Okay, we have seen methods of depreciation, and here example, here I will say the double entry for the depreciation. Okay, double entries, then we will come to the question. Okay, double entry, depreciation. Okay, double entry for depreciation. That is, we say we are going to do the depreciation. What is the double entry? Depreciation is the charge, is an expenses, right? So depreciation account, depreciation account is debited. Okay, and to which account we are going to credit, right? We are going to credit which account we are going to credit. Straight away, we some people used to charge it to the directly to the car account. Okay, that is not correct way. We have to create a provision for depreciation because this is not an actual expenditure. We are making a provision. Okay, we are making a provision because we expect, because sometimes the scrap value would have been 2000, sometimes the scrap value would be the 500. So we cannot say because everything is estimated. So here we are making an account called provision for depreciation. Okay, for depreciation. Okay, that is credit. This is the double entry. Okay, depreciation account debit, provision for depreciation account credit. Okay, provision for depreciation account credit. So this is the double entry. So here we have to open an account called depreciation and another one is provision for depreciation. This is credit, this is debit. Two items. Okay, wait video 1 minute. Okay, portion of depreciation, right? So for 3 years they want us to calculate the depreciation. So depreciation account debit for year 1, depreciation account debit 20,000, and provision for depreciation account credit, no, 20,000. Okay, for year 1, 31st of, you can say 31st December. Okay, this is depreciation. This is provision for provision. Here, year on 31st 12th, next this one also provision. Depreciation 20,000. Provision for depreciation. Depreciation is depreciation 20,000. Third year 20,000. Third year also 20,000. Depreciation. Okay. Now we have to balance the accounts. So all 3 years we have calculated the depreciation provision for depreciation. I had to balance it. Carried around 120,000. Carried down balance brought forward 120,000. Credit balance. Car account year 2 also we had to say year 2 no transaction, carried down 120,000. Here carried down 120,000. Here brought forward 120,000. Here brought forward 120,000. Okay. Here also car also like that. Brought forward, carried down, balance 120,000. Okay. Brought forward 120,000. Carried down 120,000. Brought forward 120,000. Carried down 120,000. Brought forward 120,000. 3 years. Now here depreciation. We have to bring it down. Okay. Nothing else. Because to balancing, no space. Carried down. Carried down 20,000. Right. Brought forward. Brought forward 20,000. Another 20,000 charge for the year. Okay. Year 2 provision. Okay. Then here carried down 40,000. Right. 40,000. Brought forward 40,000. Year 3 charge provision 20,000. And we're getting the balance of 60. Then this 60 is going to appear here. Here carried down balance is 60 and brought forward balance is 60. Okay. Brought forward balance is 60,000. Depreciation account. No. Depreciation account no. I made a mistake, man. This is VK. We can say expenses will be charged to the account. Provision for expenses only we had to bring it down. Here, so we had balance the depreciation. Here we will say P profit and loss account 20,000. Okay, profit and loss account 20,000. Profit and loss account 20,000. We charged. Depreciation is charged to profit and loss. But provision for depreciation, of course, we had to ca- carry down balances, right? So here we had to shift it down. Nothing. I am not altering anything. Just shifting the matters down. Right here, we'll say carry down 20,000. Here we will say brought forward first. First brought forward 20,000. Here 31st 12th depreciation 20,000. Okay, then total is 40,000. Here carry down carry down 40,000. Brought forward on first 40,000. The third charge 31st 12 depreciation 20,000. Okay, then charge for the year carry down balance 60. Carry down balance 60,000. Then fourth year 4 brought forward 60,000. Okay, this is the provision for depreciation and balance. Hmm. Then and there we had to balance it because there's a limitation in the what I call the space. I have managed it here within this space. Okay, here we have the as a space. So this is the example. Okay, you would understand. Now there says extract of P&L and balance sheet. We'll say P&L is here. Extract of P&L, profit and loss. We will say P&L, right? P&L account. Here debit, here credit. Okay. And balance sheet, non-current asset, non-current assets, non-current assets. Okay. Here expenses, admin expenses, and car is we will put it into the sales and distribution expense. We assume that the particular car is used for the sales. Okay, distribution. This car current liabilities, non current liabilities. We say yeah, current liabilities. Okay, the car I will show each and every year. I want to show the balance sheet. Okay, and P&L. End of the year transaction I will show in the balance sheet and P&L. Okay. Here we will say this is for year 1, we will say year 1 balance sheet, because in the balance sheet only in P&L, in one P&L we can show one T account P&L we can show, but in one in the ledgers we can say one we can use it. P&L and balance I have to use a separate. This is for the year 1, year 1, year 1. Okay, year 1 depreciation, cash account carried forward is 120,000, right? Cash 120,000. Okay, cash, because it has a credit balance 120,000, and car is a non-current asset, had a value of 120,000. Car 120,000, year 1, right? Year 1. Then depreciation is 20,000. In distribution expenses we will say depreciation. Expenses 20,000. Depreciation is 20,000. Provision of depreciation also 20,000 here in year 1. Provision for depreciation less, we have to deduct it. Okay, provision for depreciation 20,000. Okay, so the net value of the, in the balance sheet we used to show the car value is 100,000 because there's a depreciation 20,000. Okay, P&L year 1, this is this thing, balance sheet. And in year 2 we'll say year 2 balance sheet, P&L, P&L, debit, sorry, profit and loss. Here balance sheet, debit and credit. This is asset, this input year 1, year 2, right? This is year 2, this is year 2, this is year 1, year 1. Okay, right, year 1. In the year 2 you will say distribution expenses, distribution expenses. Here you will say current liability, liability. Here you will say non-current asset, non assets, right? Year 2 also cash brought forward, cash is a liability 120,000, right? Non-current asset of car is 120,000, car 120,000, and depreciation is 20,000, depreciation 20,000. Provision for depreciation is 40,000 here. Carry forward. Provision for depreciation is 40,000. Deducted provision for depreciation 40,000. Then value of the car is 80,000 in the year 2. In year 3, DR, CR, PNL, year 3. Right, balance sheet. This is the extent, okay? Sheet. Debit and no, this is here we say non-current assets. Current liabilities. In expenses, distribution expenses. Right. In the year 3, cash brought forward is 120,000. Cash credit balance, say 120,000. Cash and bank we say. Okay. Cash or bank. Okay. And car balance is always car 120,000. Okay. Depreciation is PNL. We are charging to PNL. Depreciation 20,000. Right. Provision for depreciation is 60,000. Year 3, depreciation is 60,000. Then we have the balance of 60,000. Right. So see, in the year 1 we had a carried forward balance of we are seeing we can have a balance of value of the car is in the year 1 balance sheet is 120,000. 100,000. Year 2 it is 80,000. In year 3 it is 60,000. Right, it is coming down. We are showing the balance lower. Okay, understood. The double entry of depreciation. Okay, double entry for depreciation account, debit provision to depreciation or credit. Okay, understood. Now I am going to raise this accounts. So before that, if you want, you can take down the figures. Okay, I will give 5 minutes time. Right. Uh, we come to the second method, that is an reducing balance method. Reducing or diminishing balance method. Under this method, the charge is more charge more depreciation in early years of an asset's life, with a progressively lower charge in each subsequent year. Under this method, we charge more depreciation in early years of an asset's life, with a progressively lower charge in each subsequent year. Right? What they are trying to say is, they under the reducing balance method, means diminishing balance method, if we apply this method, then at the beginning of the year, at the early years, I mean, for if you compare the year 1, the depreciation may be 20,000. So in the year 2, the depreciation may be 18,000. Year 3 may be 16,000. Year 4 may be 14,000. Year 5 may be 10,000. Because progressively the depreciation charges will be lower if we apply this reducing balance method. That is what they're trying to mention here. Year 1, year 2, year 3. Right? So under this method, we charge more depreciation, that is more, in early years of an asset's life, with a progressively lower charge in each subsequent year. First of all, we put a small chart for this one, because earlier example we had a straightforward amount. They have given the amount straightforward. Here we have to calculate the amount, right? Yeah, we can say cost is same. Cost for this cost, the zils has a 31st December each year. He also same, zils has a 31st December each year ending, right? On 5th April, he purchased a machine for 150,000. Cost of the machine is 150. First, jot on, note it on, identify 50,000. April, he purchased a machine for 150,000. His depreciation policy is to charge 20% diminishing balance with the full year's charge in the year of purchase. First, calculate the depreciation. Depreciation rate, depreciation rate here. Rate is 20%. At the rate of 20% we used to charge, right? So there is no lifetime at the until we complete the depreciation, it is calculated like this. So we have to mention for 3 years, right? 3 years, accounts for 3 years. First of all, we can calculate year 1. Year 1 depreciation, how much? Year 2, what is the depreciation? Year 3, what is the depreciation? Okay, you are charging on diminishing balance method. First year we are going to charge at the rate of 150,000 into 20%, means 30,000. First year depreciation is 30,000, right? Then if you reduce it, no, we will go by the accounts, right? Not to, I don't like to mislead you all, right? Here, first year 1, cash we are paying. Year 1, cash we are paying, saying 150,000. We have purchased the car. Okay, machinery. Here it is a machinery. Okay, not the car. Machinery. Right? Machinery. Year 1, we are purchasing a machinery worth of 150,000. We are debiting the machinery account. Okay, year 1. And what is the cross reference? Cash. Here you say machine. Machinery. Depreciation is 30,000. Depreciation account debit. Provision for depreciation account credit. 30,000. Here you will say year 1 depreciation. Here you say year 1 provision. So balance it now. 150 brought forward, carried down, carried down here. This one brought forward 150. Right. Machinery also carried down. Balance is 150. Brought down, brought forward 150. Okay. In the balance, sorry, depreciation also P&L account. P&L 30,000. Here carried down balance 30,000. Brought down balance, brought forward balance 30,000. Okay. Cash account is shown under current liabilities, cash and bank 150. Okay. Under the current liabilities. Machinery we are showing under the non-current assets 150. Machinery 150,000. Okay. And depreciation is charged to the profit and loss account. Depreciation 150,000. Okay. Provision for depreciation. Provision for depreciation 30,000. 120,000. As per balance sheet, but the balance is 120,000. Then year 2, we are calculating 20% in on 120,000 balance. Then 24,000. Right? Depreciation is 24,000. Then what happened is year 1 also cash at bank, no differences, right? Carried down 150. brought forward 150, right? Machinery also carried down 150, brought forward 150. Year 2, this is year 3, right? In depreciation, we are going to charge a depreciation for year 2, 24,000. Provision 24,000. 24,000. Depreciation 24,000. In balance sheet 54,000. Carried down, carried down balance 54,000. Brought down, brought forward balance for year 3, 54,000. Right? The balance sheet, cash account 150,000. Machinery account 150,000. Depreciation account is charged to depreciation. Depreciation account 24,000. Provision for depreciation account, provision for depreciation account is 54,000. Then balance is 96,000. 96,000. At the year end, the balance of the this is 96,000. 1, 2, 3, 4, 5. 96,000 into point into 20%. That is 19,200. 19,200. Okay. 19,200. So here you'd say depreciation account, year 3, provision for depreciation 19,200. Here year 3, depreciation 19,200, 200, 73,200. Carried down 73,200, brought forward 73,200. Okay, 73,200. So we had balance here also. Carried down year 1, year 2, year 3. Carried down balance is 150. Here brought forward 150. Here carried down 150,000, brought forward 150,000. Okay. Here P&L 30 24,000. 24,000. Here P&L 19,200. Depreciation 19,200. Cash 150,000. Non-current assets, machinery 150,000. Right? And provision for depreciation. This provision for depreciation for depreciation 73,200. 76,800. 76,800. Say it is on 76,300. The balance is reduced. First year it is cost is 150, and first year after depreciation 120. Second year after depreciation 96,000. Third year after depreciation 76,000. Another reducing balance method. See, depreciation calculated on 20% at the rate of 20%. Cost is 150,000. First year the amount is 30,000 depreciation. Second year the depreciation is 24,000. Third year the depreciation is 19,200. Right? Under this method, we charge more depreciation in early years of an asset's life. Here, early years, at first year we charge 30, second year 24, third year 19,200. See, and progressively the lower charge in subsequent years. Progressively lower charge in, we are charging lower charge in subsequent years. Here it is decreasing. That's what they said, diminishing method. That's what they said, reducing balance method. Reducing balance in the sense we are calculating after deducting the amount on after deducting the provision from the cost. Okay, not straight line. We earlier we used to charge on the cost. Okay, on the under the straight line. I think today you would have understood the what is the depreciation and methods of depreciation, and what is the double entry for depreciation, right? How to pass examples we have discussed, and I think you would have understood. I hope you would have understood, and if you have any queries, don't hesitate to ask me through my mail. Okay, thank you, bye. We will meet you in next session.